Hey guys, is your friend Ibrahim or IB? You can call me IB actually. So in this video, in my last video, we were able to discuss the method of calculating cost of equity, which is the dividend valuation method with growth and without growth. In this video, we are going to examine the other method of calculating the cost of equity, which is the capital asset pricing model. Please kindly watch my previous video where I said the cost of equity is calculated using three methods: dividend valuation method, capital asset pricing model, and Modigliani and Miller. So in this video, we'll talk about the capital asset pricing model and Modigliani and Miller. Capital assets pricing model. Capital asset pricing model is a method of calculating cost of equity. It is calculated as cost of equity equals to risk-free plus beta risk premium minus risk-free where RF is equals to risk-free. Another name for risk-free, you may not be given risk-free in the question. If you have risk premium, risk-free, or treasury bill, let's say treasury bill or government bond. So in every question, you may be given risk-free or treasury bill or government bond. So RF is either of the three. B, which is the equity beta. This is equity beta. When we get to portfolio theory, we are going to explain the meaning of equity beta, most especially when equity beta is less than 1 or greater than 1. What is the implication on the firm? When we get to portfolio theory, we will dissect that. Now, RM is risk market return or cost of equity is equal to risk-free plus equity beta risk premium. In a question where risk premium is given, so this is how to determine the cost of equity, where RP equals to risk premium. Now, the risk premium means that the difference between the market return and the risk-free. So, if you invest in shares, additional money you get from investing in that share is the risk premium. Why do we call this risk-free? Risk-free means that when you invest in a treasury bill, it is actually a risk-free or government bond. You know, at the end of the day, they must pay you your principal and interest, right? So when we get to bond valuation, we will talk more on treasury bill, on government bond, and corporate bond. So, you know, corporate bond is a private bond. It is not free. So there is a risk to it, right? So in this case here, RF is risk-free, treasury bill, or government bond. Why is it like this? Is because when you invest in treasury bill or government bond is what? Is risk free. That is why it is called risk free asset. Now, equity better. When we get to portfolio theory, we will explain equity better. Now, the risk premium is the additional funds, additional return you get from investing in a what? In a risky asset. Now, you take a risk to invest in Fidelity or Jitco shares, the difference between the market price or the market return and the risk free, right? We give risk what? Risk premium, which means that the market return is higher than what? The risk free. So in every question, you may be given either risk free, risk premium, or the market return and what? The risk free. So whichever one you are given in the question, you should be able to know that, okay, you are going by the first you are going by the first formula or the second formula. Now, another method of calculating cost of equity is the Modigliani and Miller. Modigliani and Miller. Remember I said when we get to under the capital asset pricing model, when we get to portfolio theory, we will discuss more on this. Yes, we are going to dissect it. So please like, comment, share, and follow us. Now, Modigliani and Miller assumption. M and M. M and M. There is an assumption here, but I will just explain when we get to adjusted present value. We're still going to dissect this. Now, Modigliani and Miller is saying that everything is perfect in the market. There is perfect information. There is no tax. There is no difference between there's no difference between the dividend and capital gains, which is very wrong because there's difference between dividend and capital gains, right? So this is what Modigliani and Miller it's saying. It's saying that everything is perfect. There is a perfect market. It does not believe in the dividend policy. So when we get to adjusted present value, we are going to dissect this and explain more of Modigliani and what? And Miller. Please kindly use the comments box, like, share, and subscribe. In my next video, I'm going to talk about the cost of debt. Bye.